people are more complacent. And complacency in a market means they aren't prepped for anything bad. In fact, they think nothing bad will happen. And again, think about this in your own lives. How many times out there have we been on our high horses thinking we are the best, we're unstoppable, and then what happens? Some curveball comes into our lives and it throws us off. And that's where the market's all right now. They're in extreme greed, where we're at a point where the investing public thinks nothing can go wrong, and ultimately that's exactly historically, and this is going to historical analysis now, that's exactly where things go wrong. So we know that we're in extreme greed. I continue to think this chart of the psychology of a market is very key. Now, there's lots of people that will say, well, this is where we are on this chart, this is where we are not. You know, a lot of people I've heard, they think we're in the optimism phase right now, just before the crazy move up. I disagree. If you look at the move from this point right here, from optimism to belief to thrill to euphoria, that looks identical to the move that happened after the COVID stimulus came in, after the 2020 March period. So again, if you look at that move up and then you factor in the drop here, this is where we are on the chart of the market psychology. We are rallying up as people are complacent, thinking that everything's going to work out. Oh, the Fed is going to perfectly make the economy just a super soft landing. Earnings will be fine. Nothing else can go in the way of anything else. The debt ceiling was taken care of. Everything is hunky-dory. And the problem is that what we know is the Fed continues to probably raise rates later this year. Yes, they will likely pause next week, but they also have, so the government, and check this out, this is not being talked about yet. In the next 3 months, the government will have to sell $1 to $1.5 trillion in bonds to the world. All right, now you ask yourself this. Number one, what interest rate are they going to have to do? Essentially, this is debt that's going to be rolling over, that they have to essentially refinance. So you're taking debt that was probably at a 1% to 2% interest rate. You're now looking at selling it to the public or to the world at around a 5% interest rate. So think about the U.S. deficit and what that's going to do to the U.S. deficit. By the way, there's a reason why when they passed the debt ceiling, there's no cap on it right now. For the next 1.5 to 2 years, no cap whatsoever, because you have all these factors here going on where they have to unload a ton more debt to keep the merry-go-round going. So now you're talking about how much is going to be sold to the world, and then what interest rate is that going to be at? And again, is that a headwind? Well, I would think so. Then you take into account